So I'm thankful at this time of year for a healthy real estate market. You might say, well, how can it be healthy? Everything I've heard says the market's a mess, falling apart, crisis, ready, things are ready to uh, um, crash. I don't think so. I don't think the data supports that. And let's take a look at it. I think that the too often there's, if you follow me at all, real estate industry information is as bad as politics or news or medical information. That the basic industry is so focused on clickbait and getting people's attention and scaring people to get onto the website and then from there sell them advertisement. It's not about education at all. Real estate is as bad as any of those. Now, just FYI, in case you notice the background's changed, we're in process of upgrading our studio here. We've got a new computer, new screens, new camera, new stuff coming in. So we're really in process. We're excited about the changes to hopefully make a better presentation going forward for the rest of the year. But anyhow, let's take a look at the data now and see really where we are based on facts and data, not where we want to say we are. So this is the best source of national data, Teradata. And if you look here, this is the inventory. And the inventory is still going down, still low by historical standards, while slightly above 2021, below 2020, which was an all-time low inventory, lower than 2019 and 18 on this chart. So we have the lowest inventory we've had in history. Now, new listings are not coming in the market very quickly because sellers are discouraged from buying new houses for a lot of reasons. For one, the interest rates went up. If they're going to trade up, they're going to trade out of a low rate into a high rate, perhaps. So that's slowing down the amount of inventory. But the sales are still in the range of what we've had in the past. Take a look at under contract, also the lowest ever historically. But there's a reason why is more off-market sales than ever before. And this has been a continuing trend over the last few months. So what happens is sellers maybe are discouraged initially, but then make deals off-market. So when you see data from the NAR, National Association of Realtors, or data talking about the MLS data, it's going to be skewed in terms of activity because there's a lot more, almost double off-market sales than there's ever been. So this is nationally. You can see that overall nationally, what's the bottom line? Sales are below. Of course, the price is higher, so the unit count is lower by 10%, 15%. The average sales price is higher than it was 2 years ago by 40%, 30%. So overall, sales have been about flat over the time. Now, let's take a look at the local stats. I'm in Los Angeles, and you can see that over the last 5 years, the inventory now is higher than we'll call it the pandemic period, though maybe we're still in or not. I don't want to debate that point. But certainly, it would be historic lows when compared to the pre-pandemic period. So while inventory has risen, and by the way, started to slow down, so maybe it might have been, hey, the market's going to get worse. No, it's not. Inventory slowed down a bit. Closed sales have dropped, but still are in the realm of what they've been over the years past, given the seasonality of things. Days on market has gone up, but still is considered healthy. And by the way, is a historic low compared to the pre-pandemic period. One of the key factors I look at also is sold dollar per square foot, which has dropped last month. But overall, the price per square foot is $555 in our MLS in Southern California, as opposed to pre-pandemic about $410. So the average house has gone up about 25%, even after this last adjustment period overall. So prices have gone up. So what is all this telling us is that overall, the market is back to maybe pre-pandemic, more normal levels, lower sales at higher price points, and adjusted, but doesn't seem to be crashing nationally or locally based on the numbers that we see. And so this has made an adjustment. I think the key difference here is the housing market is not leading the country into a depression like it did 2008. The overall economy might be headed to a depression, a recession, or not, and the housing market is being affected by it, number one. Number two, the other thing that's clear is that we are now adjusting some of the insane profits we've had over the last 2 years. Housing values went up 40% in 2 years. That's not sustainable. And we've probably given back 10% of that, a quarter of that gain. We're still 30% higher, 25% higher than we were 2 years ago, which is still, by historic standards, an incredibly good situation to be in. Now, what do you see in the news? Not that at all. Hat tip to my good friend Mark Shmagin. I saw this article a couple places, and it's all over the place. Fortune magazine put out Morgan Stanley slashes. I always love the words they use. It's U.S. housing market outlook. Here's where it sees the home price correction going in 2023. Two things are not true about this. Number one, well, I don't know, slashes is an exaggeration. Number one. And also, I should say this article is behind a paywall. You can only get it from Fortune magazine if you subscribe, but it's available on Business News in the full context. And so while this headline sounds dramatic, slashes, I don't think that they support slashes. It says here in this article in Fortune magazine, which they're trying to sell, it sees the home price correction going on. Now, it's interesting. Business News, which has the whole article, says, here's where it sees home price recovery. So here, to sell you the article, there's a home price correction. Ooh, that sounds really scary. And when you read the article in detail, all it says is that home prices, which went up by about 38% over the last 2 years, which is unsustainable, has come back down and may go back down and give up a total of 10% of that. We'll still be higher than we were 2.5 to 3 years ago by over 28%. So at the end of the day, I think more a correction is a better term than slashing their prediction. Another hat tip goes out to a friend of mine. Ooh, I forgot who this one was. I'm so sorry. I'm so lucky to have good friends who send me texts, information, and they say, hey, Bill, we think you'll like this article because it also speaks about the market, which I'm definitely involved with. But I think it was Alex Morales, if I remember correctly, sent me this article, which is another one from Yahoo Finance. And what's Yahoo Finance say? Yahoo Finance says, buckle in for a brutal free fall in home prices. And U.S. housing is in for a massive bubble, experts say. Now, a couple things about this. I'm sorry. I find it funny. First off, brutal free fall in housing prices. Wow, that sounds really bad. I mean, it would be bad. Massive bubble. That sounds really bad. But experts say they don't even believe it themselves, and they don't even stand up to say who the expert's saying that is. Here's how bad Jeremy Siegel, Paul Krugman, and 5 others think it could get. Now, how bad could it get? Well, it could get like massive depression. It could get that, let's say, Russia lobs a nuke at Ukraine, North Korea lobs a nuke at Japan, we invade China, China repels us, we'd be in a massive global depression, and the housing prices could get bad. That's not really the article, though. They're saying it's in for a brutal free fall, meaning this is baked in. This is where we're headed. Not it could get worse. The title of the article is suggesting that we're already in that direction. We're already buckling for a brutal free fall. There's a massive bubble. But again, when you read the article and go into the details, it doesn't say that. What it says is that sales have come down quite a bit. Well, that's true. Less people are buying houses, maybe because less people need houses right now that can afford to buy them, or whatever reasons there are. But it doesn't mean housing prices are going to drop. And they also say the same thing, that housing prices that ran up 38% in 2.5 years are due for a correction. And they're really projecting about a 10% correction, maybe 15% over a 3-year period, from 38 down to maybe 25%. Again, leaving us 25% higher than we were 2 years ago. Again, never getting below where we were 2.5 years ago before the pandemic. So let me ask you this. Does that sound like a brutal free fall? I don't think so. Does that sound like a massive bubble? Not at all. And so once again, I think that these experts are looking to scare you. They're looking to have you make ill-informed decisions. And the important thing is to look at the data. Now, I don't have any prediction as to whether or not Russia is going to invade Ukraine with nuclear weapons. I don't know that China won't invade Taiwan. I don't have any special information there. North Korea could launch a nuke. Iran could get nuclear. A lot of bad things could happen in the world. But based on right now where we are, what we're seeing is a modest correction to the historic gains of the last 2.5 years. And as a result, housing prices continue to be basically one of the most stable places to keep your money in the world. Where else should you put your money? In companies? They're facing the same potential catastrophic economic changes as well. So at the end of the day, what to do? As always, if it makes sense for you to buy a property because you can afford it, because you want to live that lifestyle, that's part of your discretionary income, then do it. There's a lot of great advantages to owning a property. And if you can afford to buy it as an investment because it pencils out and will give you a good rate of return on the income, by all means, you should be buying an investment property. I am in this market when I find a good deal. And it was time to sell. If you want to move to a different state, move to be closer to your family, downsize for whatever reasons, or families have to sell two-story homes because it's hard to get upstairs, there's time to sell. It's a great time to sell right now. It basically is a fairly even market. And I don't have any prediction what's going to happen in the future, but I can tell you right now is a healthy, decent market with, as we sit here, we are not buckled in for a free fall and we're not ready for explosion. We might be in for a correction over the next year or so. All that said, if I can help you, call me, text me, email me. I'm Bill Gross. And if you like these videos, please hit the like button or subscribe. If I can help in any way at all, please reach out to me. And as always, make today your best day ever. Thanks so much.